In this session, I'm going to look out for the key failure mechanisms that have happened with the dealer banks, especially during the financial crisis, wherein they have encountered a lot of liquidity risk and even the solvency risk. So, just trying to understand their major operations and what has contributed to each of these risks is something which we should look at now. So, generally, when we understand the key operations of this large dealer banks, they they provide some kind of intermediary services, right? They provide more and more of brokerage or intermediating kind of services. One in the OTC derivatives market, where they identify the counterparties, means they are actually playing a role where they are transferring the risk from one party to the other party. They are creating some kind of instruments or contracts, or they are mediating those contracts. Let's say interest rate swap. There is one party who wants to exchange a fixed interest with a floating interest. Now there is a fixed rate payer. That party wants to identify who is a floating rate payer for getting into such kind of an agreement. Now they approach the dealer bank, and dealer bank takes the responsibility of finding the counterparty and tying these two parties. So there is an intermediation service in the process, and because of that intermediation service, there is some fee or some kind of commission that is charged in the process. But what is happening in that is there is a risk transfer from one party to the other party. Similarly, for the creation of CDOs, collateral debt obligations, or mortgage obligations, or loan obligations, whatever are the products, probably this dealer bank can create that product, but it is trying to link both the parties, one the investors, two the bank, are the loans that are being purchased from the bank. So what is happening is, in all these transactions, any kind of over the counter derivatives transaction, CDOs, CMOs, credit default swap, most of the time the dealer banks are acting as a the dealer banks are acting more as the intermediaries into the transaction, and at the same time they might be playing the role of acting as a counterparties also. Now here, as long as that is smooth, no issues. But what could very well happen is, this is a chain, right? Probably the bank 1, it gets into a deal with bank 2. So bank 2 probably, or company 1 versus company 2. The bank is intermediating the transaction, and when it is intermediating, it is even guaranteeing in the process. So even if this party defaults, it has a huge impact here, right? Even if this party defaults, it has a huge impact here. And a huge defaults by this one bank will trigger the losses in the entire system, because if losses are faced by one party, the bankruptcy costs of that party could create kind of financial distress on this bank. And because all the banks are interlinked, because they act as counterparties to the other banks in some other transactions, this losses will get accumulated even at the other banks also, overall creating a liquidity crisis in the entire system, and a few banks can go insolvent. And if they go insolvent, the counterparties will try to reduce their exposure to this particular bank, or even exit from the transactions with respect to this particular bank. So in the OTC derivatives, though they do the intermediary function, in the intermediary function it looks as if they are acting as a counterparty to the other transaction. Now, most of the times what we see is for various major participants in the OTC market also are the banks themselves, and the major intermediaries also are the major dealer banks only, which means in essence it looks like the bank is acting as a counterparty to another bank. So if one large bank suffers huge losses, it will have a ripple effect on the other banks also, because they are counterparties to this bank. So because of that ripple effect, the whole system, the liquidity crunch comes up and affects the entire system. That is what we call as a systemic risk. And because of that, at least some parties which have lost very badly, they become insolvent, and during the insolvency the counterparties will try to remove their exposure with respect to this dealer bank, or at least reduce their exposure. Similarly, the other mechanism which the dealer bank gets into is the short-term repo agreements. In most of the cases, what we see is an overnight repo. You borrow overnight from the other bank, borrow overnight from the other bank, and invest the proceeds in some quick some agency securities, corporate bonds, mortgages, etc. Means the assets are generally long term, whereas the repos are very short term, overnight or 15 days, very short term maturity. And this would be slightly cheaper because of the cost of borrowing being much lesser, and one overnight kind of mechanism, the chance of credit risk is much lesser, so this credit is available for a much cheaper price. So they are used for financing the assets and all of the other banks. Now in this process, what is happening? Short maturity mismatch comes up, heavy maturity mismatch, and that can result in high leverage, especially when the markets are not working well. And because of that, the short term liquidity crisis will come up, and the lenders for your repo, they may not, which are the other banks itself, the lenders for that repo, they may not be willing to renew the repo contracts. So because of that, whatever the assets you have got into, this dealer bank might have to forcefully sell this assets, and because of this forceful selling of the assets, they may have to sell it at a less price, which could incur into losses. And because each bank is funding the repos of the other, this can again create a ripple effect, which can cause the entire systemic risk again. So even the other activity of the bank, getting into a short-term repurchase agreements or repos, also have widened the scope of liquidity risk. Then even the dealer banks get into the securities transaction, where they get into the underwriting of the securities, and even they get into the advisory to the companies on the mergers and acquisition transactions and all. They generally do entire these things either for a fee or a commission kind of a basis, and it's a one key source of revenue for this dealer banks. Now if there is a doubt or a concern regarding the insolvency of this dealer bank, which can arise because of any of these processes, then they would stop getting the revenue even from this basis also, which could even more create a liquidity crisis for these kind of banks. And on the other side, they act as prime brokers for the hedge fund transactions. They are the prime middleman for the hedge funds transactions, where they take care of various activities: custody, clearing, lending, cash management, and all these things. Again, here also, if at all there is a solvency issue that is associated with this bank, all their clients will stop reducing their positions. So if they are reducing their positions, the collaterals which they have given, that management becomes more and more weaker. Overall, the liquidity crisis comes up. So what we are saying is, because of the solvency issues associated with the dealer bank, this can pump up the liquidity crisis and increase the liquidity risk in the overall system also, because of the correlation that is existing across the various banks on the same thing. Even the various traditional commercial banking activities are performed by the dealer banks. Just like a traditional bank, a run into the bank, some kind of rumor spread that the position of the bank is not that good. Immediately a run into the bank happens, where the withdrawals increase much heavily, and the lack of sufficient funds or probably inability to raise capital to fund these withdrawals, it creates a severe liquidity crisis within the bank. But again, to some extent, now we'll see towards the end also. Earlier there was no such kind of even a discount window for these for the, it means access. So when I say discount window, it is a mechanism to borrow from the central bank. So even if this mechanism was not there, the severe liquidity crisis had the run into the bank had even caused a severe liquidity crisis, because the availability of credit was not at all possible with the banks, which made the overall market itself to slow down. So these are some of the major activities of the dealer banks which had caused impact on the liquidity in the financial crisis period. So they generally operate either as holding companies, performing commercial banking, investment banking, brokerage, all these kind of activities. They act as underwriters in the securities, underwriter of securities in the primary market, and they provide a lot of liquidity in the secondary market. In the derivatives OTC market, they assess the negotiations between the two counterparties. So overall, they are under the umbrella of holding companies, and they have various large asset management divisions which take care of the various asset management services like cash management, custody of securities, brokerage and all. And even they introduce some kind of products where they act as a general partner, and so many limited partners are the investors in that particular firms. So all these are the various mechanisms in which the dealer banks operate. And it is known, it is earlier it was thought of that if a dealer bank comes under the umbrella of a holding company, there is a lot of advantage with respect to the usage of information technology, with respect to marketing, right? Cross product selling can easily happen, financial innovations, combining the products across the various verticals. So all these things could definitely create economies of scope to the company. But on the other side, this has created a problem also. It with respect to the risk management, it did not create economies of scope. Rather than that, it has created the diseconomies of scope. It was felt that from a risk management dimension, had each one been, instead of being a form of the holding company, if it had been treated as a separate individual isolated entity, the risk management would have been more and more easier, because it was found that the executive management and the board of directors did not understand this enterprise risk management kind of a framework, and did not know the mechanisms to control the risk at the individual companies level along with the overall broader level. And even the off balance sheet transactions, etc., they were not properly understood, especially where there were so many transactions existing within the group companies itself. So this is one more thing that gave rise to the thinking that there was a lot of diseconomies of scope, especially with respect to the risk management and even on the governance aspect also. And when we talk about the factors that are causing the liquidity crisis, see, sometimes what happens is whenever the solvency of a bank is a concern. Once a solvency of the bank is questioned, all the clients or even all the counterparties which for which this bank is a counterparty, they will reduce their exposure. What are they doing as a part of reducing? They are restructuring the contracts, or they enter into the offsetting derivatives contract with the same party. So probably if the long position was for $100 million, they would enter into a short position probably for the same $50 million with the same counterparty. So overall reducing the exposure in the transaction. Or they could even take it to 100 million and then exit out of the position altogether. So in some cases they can reduce the exposure, or in some cases they can exit out of the exposure. Similarly, initially if they have entered into in the money kind of options, they would revise them to at the money option. So because of that, the price of the at the money option will be much lesser in case of call and much higher in case of put compared to the in the money option. So depending on the strategy, if they are revising the at the money options to in the money options to at the money option, there is a cash flow that is generated in the process. So by taking the cash flow, they are reducing the size of their exposure. Whatever is the mechanism they are following, they are trying to reduce the size of their exposure with the counterparty whose solvency is under a big question. The other interesting aspect in this process is the novation to the other dealer. Okay, this particular, let's look at like this. A and B are the two banks, are two parties where probably B is a bank, dealer bank. They have got into some kind of a contract. Now the solvency of this bank is under question. So what A can do is, it can approach another dealer bank for a protection against the default of this particular bank. If this particular bank defaults, this will pay the protection to this. In turn, on a regular basis until this default occurs, this will keep paying premium to this party. This is the way actually the credit default swaps as instruments got created. And this entire procedure where we are trying to take the protection from some other party against the possible losses of some other party is what we call as the novation process. So this process which we are talking of is exactly the idea behind the working of a credit default swap. So you are going for a protection from another dealer bank. You are going for a protection from another dealer bank against the risk of dealer of the first dealer bank. So in this case, what is happening is the cash collateral of the original bank, whatever was the collateral with this bank, you are transferring it to this the second dealer bank which is offering you the protection. So in some cases, especially when the derivatives mechanism is used nowadays, the centralized clearing house is a mechanism that is being employed to try to avoid these kind of counterparty credit risks in the process. And because of the solvency issue, even the repo creditors may stop renewing their repo contracts, which again creates a liquidity shortage. And even the deals in which this particular dealer bank is the prime broker for major hedge fund contracts, even their clients try to reduce or exit their positions. Even that is what will create one more liquidity crunch within the dealer bank. All these things can really aggravate the liquidity crisis at any dealer bank. So by entering into some of the deals like banks line of credit or holding a good proportion of cash and liquid securities, increasing the liquidity or having high proportion of high liquid assets and laddering maturities in the liabilities, all these things can really reduce the liquidity crisis at the dealer bank. Then if I have to look at a comparison between a dealer bank and a traditional bank is more like a commercial bank, right? As far as the run is concerned, means if at all people start sensing that the solvency of the bank is a concern, they may immediately start doing the withdrawals. And because of these withdrawals greater than the reserves that are there with the bank, a lot of and bank not being able to raise additional capital to fund these withdrawals, a severe liquidity crisis can start coming up. So as far as the run mechanism is concerned, there is not much of a difference between a traditional bank and a dealer bank. But with respect to the institutional mechanisms, as we have seen, right now, they acting as a primary brokers, or they act as a counterparties to other transactions. So they create a kind of a loss in the various other institutions heavily, and at the same time they can even cause the systemic destructiveness itself because of the interlinkage between the various dealer banks for various transactions. It may cause a kind of a ripple effect which could cause the destruction to the entire system, whatever, whether they are getting into a OTC derivatives transactions or even the repo based transactions or securities underwriting kind of transactions or prime brokerages in the hedge funds. Any of these transactions, what we generally see is the systemic destructiveness is much more higher in case of a dealer bank compared to a traditional bank. So to make sure that this firm specific and systemic risks are reduced to a large extent, there was a program that has come out called as Troubled Asset Relief Program, called as TARP in short. Troubled Asset Relief Program, which had a major intention of helping the dealer banks which were suffering from heavy liquidity crisis, help the dealer banks which were suffering from heavy liquidity crisis, and in turn the overall financial industry recover from the crisis. And for that, what is that they are doing? The first step they said is they wanted is mitigate the effect of adverse selection, especially for toxic asset markets, where we talk about, let's say, CDOs which are backed by subprime mortgages. So because they are backed by subprime mortgages, the buyers of the CDOs, they generally want these securities to be sold only at a deep discount. they are willing to buy only at a deep discount. And because of that, what is happening is the dealer banks, they are forced to sell off these assets at a much lesser prices, because the buyers are not there and they are more illiquid. They are incurring even more additional losses. And to avoid this doldrum, the TARP is targeting to offer the below market financing for the buyers. So the rates, the TARP has targeted to introduce the rates which are much below the market rates, and at the same time absorb the losses which are beyond a slight threshold level. That is one mechanism they have come out to at least improve the situation. Otherwise, the dealer banks were losing pretty badly because of not being able to sell those CDOs and all at normal price. They are forced to sell at much lesser prices, creating more and more risk into the system. And apart from that, there has been a new mechanism, a new secured lending facility has been provided by US Fed as well as Bank of England, which is a kind of a tripartite repo. It has lesser conflicting incentives and the discretion in rolling over the repo positions of the dealer bank, and it is separated from the other clearing account functions, which means because of the tightening of the dealer's cash management flexibility, which is also a measure to reduce the systemic risk. The another concept that has come up on the same lines is the concept of emergency bank, whose role is to manage the orderly unwinding of the repos on a gradual basis, unwinding the repo positions of the bank. But during this time, if any of the clearing banks face losses, it has given a discount window access to this emergent bank. If required, this emergency bank can borrow from the central bank and have the proper backup to ensure these clearing banks from any kind of losses they are facing during this unwinding process. And a mechanism of a centralized clearing house will definitely reduce this kind of systemic and liquidity risk associated with the derivatives, OTC derivatives kind of transactions. And earlier there was a scenario that some banks were deemed too big to fail, but wherever there is an identification of those banks, because with the financial crisis even those banks doomed heavily. So wherever it was understood that these banks are too big to fail, the TARP program has come out with a mechanism to provide bridge banks which offer similar kind of a mechanism like the traditional commercial banks itself. So these are some of the things which we need to understand as a part of the failure mechanics of the dealer banks. In case of any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.